Welcome to Investors Corner. I'm your host, Athena Paquette Cormier, and I'm glad to have you tonight. Or if you're listening on a podcast, glad you're listening. This podcast, as you may know, is for people who invest in real estate or own real estate and want to grow their wealth, protect their wealth, and build generational wealth. So we're so glad tonight to have with us Sean Boatman, who is an insurance broker, and he has many, many years of experience. And I was approached by his partner, Aaron, who wanted to talk about mortgage protection insurance. And I said, mortgage protection? I don't want to protect the bank. But anyway, I'm letting them on anyway. So we're going to talk about mortgage protection insurance. How is it different from life insurance? And is it PMI? Who is getting protected here? That's what we want to know as homeowners and investors. So welcome, Aaron. So glad to have you here. And why don't you just introduce yourself a little bit and tell us, were you born and your mom had you in her arms and said, you're going to be an insurance professional one day? Or was it like something that evolved?
Oh no, so I'm Sean Boatman. I'm the owner of the Boatman Agency, and yeah, I run a nationwide agency. Have agents in pretty much every state of the country, doing anything from cash growth, life insurance policies, IULs that might be of interest to your investors, to participating whole life policies that we do. And we do an awful lot of mortgage protection, and we do a couple of other unique things too, that involve paying off people's mortgages and all their other debt in 9 years or less by leveraging some of our real estate techniques coupled with our insurance instruments that we use. Been doing that for probably 6 years. And actually, no, I was more on probably a lot of your listeners' side. I was actually a builder on the construction side for
Oh,
many years, and also flipped probably 30 houses as a private investor using hard money and regular institutional money as well. So I've got,
oh, fantastic. So
yeah,
you're
I got
one
a
of
lot of
us.
knowledge across all of
Hey,
it.
I love that.
And no, nobody grows up going, I want to be an insurance agent when I grow up, Mom. That's not how that works at all.
Yeah, I don't remember anyone saying that, but
Yeah,
it could have
exactly.
been.
Yeah.
Probably the insurance agent's son, maybe, or daughter, maybe.
Yeah, maybe so, but it's been good to me, I'll tell you that.
Fantastic, fantastic. Well, great. So why don't you can you share with us exactly what is mortgage protection insurance?
Yeah, so you mentioned it just a minute ago, a little bit of a difference. PMI that, is most people that are doing real estate, or if they're on the mortgage broker side, they're familiar with PMI, which is private mortgage insurance, which is built into the policy. It's a requirement, or not into the loan, I should say. It's a requirement from your lender. In the event that you default, it makes up the difference between what they would have wanted you to put down and what you actually put down. So it's an insurance policy that protects the lender. Mortgage protection insurance, though, sounds very much the same. But when you buy a property, or you do a refinance on a property, or take out a mortgage on it, what have you, you'll typically get something in the mail. And it'll say, hey, you may qualify. Excuse me, you may qualify for a policy that would pay your mortgage off if you pass away, or make your mortgage payments if you become terminally or critically or chronically ill, that sort of thing. And that's for the borrower. That's, in this case, like if you had bought a home, Athena, you would get a policy like that, potentially. And they used to actually do this at, point, really at escrow, as part of your escrow closing, used to be built into your actual loan. And
Mm.
that stopped happening maybe 10, 15 years ago. It's not nearly as prevalent at that stage. So it happens post-sale now. And it's
I do
advisable.
remember that. In fact, I think because I failed to tell you, I'm a mortgage broker of 35 years of combat experience.
Yeah, right there you go.
But I do know on our application or maybe the loan docs, there's a little box that says, "Do you want credit life? Do you want that?" There's like boxes that you can voluntarily
Yeah,
kind of sign up for. I do remember that.
yep.
And
And
now
it
so
kind
it's
of
post closing.
Yeah, it kind of went away just because it was a cumbersome thing for most, mortgage lenders to do, that they weren't familiar with the underwriting. They didn't have maybe all the resources. They couldn't get people
Mm,
insured, and it would delay their closing. So they'd be like, "Hey,
mm,
we're sitting here trying to get this insurance policy. It would be a great benefit to the borrower, but
mm,
they got some health issues. We can't figure out how to get it underwritten, get it done." And so then it would just slow things down. And so most people stopped doing that.
mm.
So now the approach is, if you close a loan, that's a public record, and you get something in the mail saying, hey, this may be something you qualify for. that
Mm,
lead, I get that lead. Let's say if people fill it out and send it in, and I call those folks and write their insurance for them, and then often find out, that they might be interested in, not just making sure the home's paid off if they die, but, rather than paying it off over 20, 30 years, paying it off in 9, um,
mm,
saving hundreds of thousands of dollars worth of interest. So then they can go invest in retirement or other
mm,
cash growth opportunities. So we're deep in that field, and there's huge debt problems in our country.
mm,
And a lot of
for
people can't
sure.
get to investing because they're drowning in debt. So we take care of the debt
Right.
first.
Right, which is totally smart and kind of finance 101, but there's the idea of what you should do, and then there's the actual doing the thing that you should do, right? So
Correct.
so
Yeah.
why don't we park that for a second? So on this,
Sure.
the whole idea of paying off the house in 9 years is fantastic. We'll get back to that. But on the mortgage protection insurance part, so is it like life insurance where term insurance is like for 20 years or for 30? Is there a time frame? I'm assuming it's probably the mortgage time frame. Um, how is it
Yeah.
different from like, should I get life insurance or should I get mortgage protection insurance, right?
Yeah, really common kind of question to ask, and they're really built on the same thing. Like all insurance, when it comes to a benefit that's going to pay out upon your death, whether you call it mortgage insurance or you call it final expense or you call it term or you call it whole life, they're all forms of life insurance. But what we're talking about when we talk about mortgage protection is what are we asking this particular insurance policy to do, right? Maybe, and this is probably a terrible analogy, but I'm going to try it anyway. It might be like saying, a tent, a condominium, and a single family residence are all forms of housing, but we're really asking each one of those forms of housing to do something different. And with
Mm,
mortgage protection, we're saying, yes, it's built on a life insurance policy. You have to qualify for it, for health and things like that. But with the mortgage protection, what's happened is that these policies now get written in 30 minutes, 99 times out of 100, no blood, no urine, no medical exam.
okay.
And we get that policy approved, and we're making sure that it's not just something that gets paid out when, the policy owner dies, but also gives them money if they become terminally, critically, or chronically ill, and maybe they're in a position where they can't work,
Mm,
and they can't make the mortgage payments.
right.
The flips that I did when I was flipping houses, we knew for a fact, and out here in Washington State, that the majority of those homes that would go through foreclosure happen because of either a significant health issue, a death, or a divorce. So we can't solve the divorce piece, but we can solve the death of someone in the home passing away, or, losing the ability to make payments and potentially lose the estate due to, terminal illness or critical illness, that sort of thing.
Mm.
Um, yeah, and then we can get just about anybody insured now too, because we're brokers. We've got access to everything.
Yeah, which is fantastic. I always tell people to go to a broker. I mean, I'm a broker, and I've been a direct lender, but I think having options and presenting
Yeah,
many options is so much,
right.
healthier. Yeah.
Yeah,
Um,
exactly.
so if someone, so yeah, so dying, that's kind of not a good way to collect on insurance, right? But if you're if you're not able to work, that's like the worst in between because you feel helpless, right? And you're in a position where you're vulnerable, you're weak because of that illness or whatever's going on. Um, so I like that part a lot. How long do you have to be ill, or what's the process of proving that you're debilitated enough to where you need that money? And how does that kind of work?
Yeah, so it varies by carrier, but they usually have, because they don't want to try and describe every illness under the sun. They usually got like these buckets. Chronic illness, you can't do, let's say, maybe three activities that are associated with daily living, like, eating, bathing, toileting, transferring, dressing yourself, these sorts of things. They go, hey, if you can't do three of those things as certified by a doctor, you'd probably qualify to be able to advance some of the life insurance money to
Oh,
yourself while you're still living. That's why it's called a living benefit. And then, a critical illness might be, something more severe. You're really debilitated due to something serious, heart attack, major stroke, let's say something like that. Terminal illness usually means you've been, certified by a doctor as having something that they expect, would take your life within 12 months. And
and is that typically it that they determine 12 months to be the measurement, I guess?
For a terminal illness, that's what most of them will
Okay.
will you know will describe it as. Yeah, in their
Okay.
language, they'll say terminal illness is something that a doctor estimates would take your life within 12 months. And so, why this is important to people who are investing in real estate or even just have their own home is everybody kind of thinks traditionally with life insurance, well, if I die, the family's got money, but they oftentimes don't realize that financially speaking, becoming critically ill can be almost more financially difficult because you can't work, but
Right.
costs are going up.
Yeah.
It's like, I mean,
That's what I mean. The in between is somewhat worse than,
it is,
the
yeah, it
finality
can,
of death.
yeah. So the living
Yeah.
benefits piece is huge. Not everybody, we don't structure it the same way with everybody, but the goal is to say, hey, if the worst happens, what happens to the family estate? And especially, many of our clients will find out, Athena, that they go, well, if I lose my spouse, I'm in trouble quick because he or she's the primary income earner.
Mm-hmm.
And if I lose that spouse, I'm not going to be able to stay in this house much more in about 90 days.
Right.
And then we'll, dig a little bit more and find out maybe they've got a bunch of equity in the home. And we're going, this estate is in trouble. We'll put
Yeah.
together what I'll oftentimes refer to as a critical period coverage plan where I'll just make sure that the family's got a small, affordable policy that'll help them make the payments or cover the whole payment for a year or two. So if they
Mm-hmm.
lose their spouse or if something happens, they've got the time they need to get out of the estate and exit and get the equity out and not, lose it,
Mm-hmm.
things like that. So it's a really smart way to cover and make sure that, equity is protected and taken care of. They are built on traditional life insurance products. But you can do very creative things with them. So that's, what we get into with our clients and, find out
Mm-hmm.
what the pain point is and try and solve it.
Mm-hmm. So in this period, let's say that you're um, temporarily disabled, is this insurance policy going to pay out just exactly the mortgage payment? Like, for example, some people's mortgage payment is only principal and interest. Some people's mortgage payment includes taxes and insurance. Some people, yeah. I mean, those are kind of the two.
Yeah,
Like, how do they determine the dollar amount that they're going to pay, and for how long do they pay it before they say we're not paying anymore?
gotcha. So in the old days, when you used to do this and it was actually tied to your loan, they would send the money to the lender. And it would usually be like, it could be structured different ways. I mean, that was, 15, 20 years ago. So but the way that it works now is that if you were my client and you had a property, let's say you owed 200,000 on it, um, if I wrote a policy for you for 200,000, that money would go to you if you qualified for, critical or terminal illness advance on that policy. Um, that money would go to you, and then you would send it to the lender in the amount that you needed, either monthly payments that you would send in, or you could pay the whole mortgage off, depending upon
Mm,
those variables. But it's not an amount that goes to the lender. The money goes to the beneficiary now, which gives them all the power. They're like, okay, I can keep the home, I can rent the home, I can sell the
mm,
home, and it's going to give me time to not have to worry about the payments. And there's
mm,
calculations in there for all that. Chronic illness riders, they won't give you as much of the total life insurance upfront. Critical illness, they'll give you more. Terminal illness, they'll give you almost all of it while you're still living.
oh,
Um,
that's
so
amazing.
yeah, it's really helpful. I mean, if you're doing heavy investing or flipping houses or whatever, I don't know if any of how you folks finance their investments, but they're
Mm,
good policies to have. If the worst happens, it doesn't end up, you know, impacting the whole estate or the whole portfolio.
And so, can you get one of these? I have so many questions. Can you get one of these only on owner occupied properties, or can it be on the rental properties or the flipping properties? Like, what properties are they doing
It
this
won't
on?
it won't ever be tied to the actual address. It's based upon your kind of need of insurance and what
Oh,
your total risk is. It'll never be tied directly to any one piece of real estate. So if you said, Sean, I got
interesting.
$200,000 worth of debt, it doesn't matter to me where that debt is located because the money's going to come to you and it's portable. If you sell that property, but you're going to buy another one, be like, great, you've got that coverage in place just for
Mm-hmm.
that particular project,
Mm-hmm.
as part of your overall, your overall risk analysis and risk plan.
Mm-hmm. So if I'm hearing you right, then I could say, okay, I have, 4 or 5 mortgages that would be too much for my spouse to handle if I was gone, or if I was debilitated, it would be too much. So
Yep.
I could just add all those together and say, let's say it's $2 million. Then I
Yep.
could get insured for $2 million in mortgage protection.
Yes,
Is that correct?
potentially.
Okay.
Potentially, subject to underwriting, right? So
Mm-hmm.
you'd have to qualify for that product.
Mm,
And they,
okay.
then they ask all the things, how old is a person? Do they smoke? What kind of medications do they have? What kind of past health things?
Mm-hmm.
Um, Usually in those scenarios, what makes sense for most people, not always,
Pardon me.
by the time we get, once we're out of our 20s and 30s, getting $2 million worth of coverage starts to become expensive.
Okay, right,
You know what I mean? Because it's a lot of coverage. I'm 55 and $2 million on me, even if my health is perfect, is not an inexpensive thing.
right. Okay.
But I've got investment properties, and probably what I would do, and what I have done, is to make sure that there's coverage in place that would give my wife a year or 2 or 3 years to exit all those
Right.
investments so she's not drowning in payments. Because if I die, the bank doesn't call her tomorrow and go, hey, send us that $300,000 that you owe on that property. They just want the
No.
next payment.
Right.
So the way that you protect estates in that scenario, if there's, a lot of debt, and it would might be the case that, if I die, my wife's not going to go rehab a house on her own. She's probably going to let all that stuff go. She needs the time to get it done so she can make
Yeah.
good decisions and
Well, and
call a
life is
realtor and do
upside
it.
down when there's a big event like that, right? So even if
Yeah.
she has the talent to do that, she's not going to feel like going out with a hammer,
No,
you know,
they tell you when you get into
right after.
insurance, they tell you when you get into insurance that that the stats will say you shouldn't make any big decisions for probably a year after
Yeah.
you lose a significant person in your life because you're just processing and going through a grieving process. It takes
Yeah.
about a
Your
year.
choices are not, your ability to choose well is, compromised, right?
Yeah, that's exactly
Mm-hmm.
right.
hmm So I had heard that mortgage protection insurance actually the value of it goes down over time. Like, and maybe
Mhm.
this was the old policy that, as your mortgage balance went down, the policy's value went down. Is that still true or?
It's not true anymore. That used to be how it worked. And, that's really kind of a bygone era of, when they were doing that as part of your escrow closing. There were
Mm,
policies that did that. You could still find those anymore, but, it's not usually advisable to have a policy that's decreasing. Most
yeah,
of
you're
our
losing its
clients,
value, right?
yeah, and most of our clients, when they come in, to us through the mortgage protection lane, they're going, well, they don't have well, they're in an interesting spot. It's usually, they're going, gosh, I got the biggest debt I've ever had in my life. And they're starting to think to themselves, if anything happens to me, I
Yeah.
mean, nobody can pay for this. And
hmm
usually a lot of people don't have even their traditional life insurance instruments in place. So we go, look, why don't we, um, why don't we solve a couple problems in one fell swoop here and make sure that if the worst happens, that your family's left with a free and clear house. Um, but if the best happens and you're paying off your mortgage like regular, you've got just, traditional life insurance that's there for you for years. And we can even build ones that, will grow cash value inside the policy that can continue on after they have paid the mortgage off. To
hmm
supplement their tax-free retirement and things like that.
Right.
So there's a lot of angles to do that to make sure that everything's taken care of, and that a lot of the risks are eliminated.
Mm. Yeah, I see a lot of clients where if something happened to them, their kids are not able to make payments, and the
Right.
so-called godparents or whoever their legal guardians are, that could be a huge like burden. You're not always in the same economic level when the godparents might be younger people, and you might be like so to leave that burden behind too. You're risking that your kids won't get what they you wish they could get, right? Because you didn't set up a payment plan like who's going to pay this debt for them, right? So, and not everyone can take over these kinds of debts financially. So, yeah.
Most can't. I mean, my kids couldn't. I mean, I've got some, properties that have got some equity and things in them. And if my
hmm
kids are young, they're just getting started, but I want that to
Yeah.
go to them. But there's no way that if something awful happens to me, they're going to be able to do that.
Mm-hmm.
So, for your clients that are out there that have, life insurance, you go, okay, well, that's going to take care of most of that problem. The only thing that we usually advise is to say you should do reviews on your life insurance. It's changed a lot. It's,
Mm-hmm.
it's changed a lot. What you can do with them have changed a lot. And there's different things that are available. It's not just, get a term policy anymore. There's some wild things happening in the insurance space that's worth looking at as part of your overall investment and portfolio approach.
Mm-hmm.
Um, so yeah, we just have those conversations all day, every day, with the teams, and the 8 agencies that we're building under mine is full of
Mm-hmm.
people that are learning this all across the country.
Yeah. Oh, interesting. Yeah,
Hmm.
yeah, yeah. So is mortgage protection insurance cheaper? Are the premiums cheaper than term life insurance? Like I'm trying to figure out who does this mortgage protection insurance and who does the life insurance. Like what's the difference? And
Think
maybe
about
you
it
can
this
clarify a
way.
little bit. Mm,
Yeah, I know the confusion. Mortgage protection is not a product per se. We could write a mortgage protection policy with a term policy or a whole
oh,
life policy or an IUL policy or a
I
participating whole
see.
life policy. So it's not a particular like, oh, that's a mortgage protection policy. It's more about what we're taking a policy and asking it to do, and how we're
Okay.
designing and crafting the policy that makes it, okay, that's something that's specifically for mortgage protection.
Okay, so this is making more so you're labeling that and then finding the tool that will execute that function, the
Yeah.
insurance tool, but that best fits.
Yeah. Like for instance, I'll get some seniors. This happens all the time. I'll get seniors that'll have a good amount of equity in their property, but they're getting older in their life, and their budgets are tight because they retired and they're living on fixed incomes, but they've got an estate that's got some, wow, it's got some great equity in it. And many times I'll be talking with them and say, how much equity do you have? Well, probably about 300,000, because the property's worth 450 and we owe 100,000. Okay,
Mm-hmm.
what are those payments? Well, the payments are like $2,500 a month. I'm like, okay. What would you do if either of you passed away? Would you guys keep it, sell it? No, if he passed away, I wouldn't want to live here anymore. It's too much property for me. I'd want to sell it and downsize. Okay. Well, in that case, with that particular client, I'm going to say, I want to think about this more as like an equity protection kind of plan. What do we got to do to protect the equity? And for them, because they're not spring chickens anymore, I'll probably use a whole life policy that I can get issued without, any pain or hassle on their part, no blood, no urine, no medical exams, just something that's going to make the payments for 1 year.
Mm-hmm.
Small $30,000 whole life policy, right? So when you're doing mortgage protection, it's not so much the product, it's the intentionality behind what you're trying to design for the client to solve that particular need. Um,
Okay.
that could be term, that could be IOL, that could be whole life, that could be lots of different things in the insurance umbrella. So we just have to get into it case by case and find out what's going to be best for that client.
Okay. Well, I'm
Yeah.
glad that cleared it up, and I'm glad it's not that declining balance insurance from years ago because I thought, my God, like, anyway. So it's not that, so we can let it go and I can feel better.
And it's not that.
It's not that.
Although
Um,
if you want it, which I know you don't, but if you wanted it, you could probably find it out there somewhere, but we don't offer it.
Yeah, yeah. Well, just like buying cars, like they depreciate. I don't like that either. My car's a 2006 just because I want to buy appreciating assets, not depreciating assets. And here I'm buying insurance, which, and it's going down. I thought, oh, this is crazy. So,
Yeah,
okay,
there you
good.
go.
I'm glad we cleared that up. So, can
Yeah.
you now share with us this idea of paying off our home in 9 years? How does that work?
That's wild. And that gets fairly complex, but there is a way to leverage a participating whole life policy that allows it to grow cash in such a way that you can borrow against it and eliminate debts through the cash accumulation in the policy. It's a complicated formula. You have to
Hmm.
have software to even run it. At the end of the day, what ends up
Well, you
happening.
would do that, not us, right?
Right. Yeah, no,
Okay.
I have
Like
I
you
have
need
a
software. I'm not buying software to
no, no,
figure
no,
this
no.
out.
My advanced market team, I have specialists that do just that. But
Okay.
the layperson's kind of level of things is done right. On average, we can usually eliminate um, families' entire debt, their mortgage, their credit card debt, their student loans, their vehicles, everything else, without spending more every month than they're currently spending. Now, that doesn't
Mm,
always quite work, but most times we can find stuff in the budget and say, look, a lot of times people are overpaying on their mortgage. They're making an extra payment per year, or they're paying a couple extra $100 per month on a credit card, things like that.
right.
We find the black hole money or the overages that they're spending towards things like the things I just mentioned, and we shove that into a participating whole life policy that grows cash value quickly. They get a chance to do these mechanisms where they get to borrow against that pay down debt, roll it in, and wrapped into that whole thing is kind of this Dave Ramsey, this snowball effect of paying down debt and eliminating debt.
Hmm.
And when we project those formulas out, many times we'll be able to. I think the longest one I saw run out was about 14 years. But there's some variables to that, so nobody, hang me
Yeah.
up to on the fence post, if the numbers
Hmm.
don't work your way. But it's an amazing thing, and it's hundreds of thousands of dollars worth of saved interest, hundreds of
Hmm.
thousands, and it
Yeah.
changes people's entire retirement trajectory. And everybody needs that product, whether you have a mortgage or not.
Hmm.
Average Americans got debt coming out their ears, either in student debt or consumer debt. So it's not something that
Hmm.
has to be tied directly to a mortgage either. If you have debt and you want to
Hmm.
accelerate getting that paid off, we've got the product for it.
So if I'm hearing you right, it's a whole life policy where you're uh, saving as much as you can into it so that you can borrow out of it and pay off debt. And meanwhile, it's still growing, something like that.
Yeah, something like that. I'll leave it to my advanced
I'm just
market
trying to give
pros
people
to
an idea of how it functions or how the money's flowing to make that work, right?
Yeah, yeah, and I will totally butcher that because I'm not the advanced market person to do that. If somebody is interested in doing that and they want an analysis,
Mm-hmm.
they could certainly get with my advanced market team there on that,
Mm-hmm.
and they could do those run those rates, run the trajectories, show you kind of how that all plays out. It's very
Mm-hmm.
fascinating. So a lot of the insurance agents that I have also get those plans on themselves because like, hey, yeah, I've got debt. I want to get rid of that.
Mm.
It's a pretty fascinating thing. Life
But if I
altering for
heard you
them.
right, you're shifting one expense category or one overage, or you're shifting some of your cash flow into this product, and that product is somehow growing in order to pay off debt, something like that.
Yeah.
Okay.
Yes, it will. And there's because because the money that you're putting into some of those policies grows, there's a compounding interest effect that's in there. So there's a mathematical formula that allows you to leverage that in such a
Mm-hmm.
way that you can't do out in the open market, right? And
Mm-hmm.
it still allows the client to be insured and effectively use their money twice. Because
Yep.
even when you borrow against the money that's grown inside your cash value, it continues to earn interest on the full amount that you deposited, whether you borrowed
Mm-hmm.
against it or not. So
Yeah.
there's some really
I
interesting
had
things
one of
there.
those. Now that you're describing it, I had one of those. The interest that they were charging, and this is 15 years ago, but I paid for my wedding by borrowing against this product, this life insurance product.
Okay.
And the interest charge was 1%, but it was growing at, even though 2010, 11 was not a great time, but
Yeah.
it was growing at much higher than that, right? So the account was still growing. Meanwhile, I had this loan, right? And they let you borrow a pretty high loan to value or whatever they call it in that industry, right? You
Yeah.
get to leverage it pretty high. So,
Yeah, and there's different products that do that. They all don't do that. They don't all perform the same way. Like a participating whole life product is very different
mm,
from an IUL. Like an
mm-hmm,
IUL is tied to the Standard and Poor's or some other market index and things like that. But it's getting a little too far in the weeds. But the general concept of what you're explaining there is correct.
but
Um,
several products could probably help people reach that goal. They just have to sit down with someone like you and determine kind of which one works best for them or which one, because it probably depends on like your age and it depends on a lot of things, right? So,
yeah, it does. And there are variables. Not everybody's looking to get out of debt. Some people like I have clients who will, place $3,000, $4,000 a month
mm-hmm,
into particular, like I build what's called a max accumulation cash growth IUL.
Okay.
And I have people who get those that go, hey, I, I want to pay as little of this money I put in every month on insurance as possible. I want all the rest of it to go to cash growth. So I
Mm-hmm.
run the illustrations for them and say, here's how you do that. I only get paid on the insurance piece. So I tell my clients, I say, hey, if you got to work with the right person on this because they're going to try and structure this in a way that includes a lot of insurance. But if you're working with
Mm-hmm.
somebody who knows what they're talking about, you can structure a policy and say, hey, if you want to put money into this, you can have life insurance benefits in there, living benefits that's in there, and your cash is going to grow inside the policy according to a market index, which we think is going to be doing very well over the next few years.
Mm-hmm.
Um,
And I love that idea because you're like triple dipping your money, right? You're getting
Triple
insurance, you're
diving.
getting savings, you're getting like where else are you going to borrow? I am a lender, okay? I do SBA, FH, okay. But where are you going to borrow money where there's no qualification, right? They don't ask you for a paycheck to borrow against your account, right?
No, there's no,
So
it's like if you,
working, not work, it doesn't matter. You have access to a loan that's actually pretty reasonable in interest too, right?
well, think about this. There's an interesting strategy that people do. So, if my daughter just bought a car the other day and,
Good
she
for her.
bought a used car, paid cash for it. It's like, okay, that's really interesting. But we didn't have her IUL set up ahead of time, but, it had, because she's only had hers for like 6 months. And,
Mm,
but if she would have been down the road a little bit further, I probably would have said to her, or if she would have been looking at getting a loan on the car or something like that, I would have said, well, don't go get a loan. Just borrow it against your insurance policy because you're going to get a free and clear title. The
mhm.
bank's not going to have the title or have they're not going to have, what do they call it? Not the title, not a UCC file. I can't remember what the,
Yeah, a lien on the, yeah.
yeah, a lien. There we go. You lien on the title. You're just going
Hmm.
to get a free and clear title. You don't have to qualify for it. You don't have to ask permission for it. You just have to call up the insurance company, say, send me a check for X. You can go
Yeah.
spend that on whatever
And
you
right now,
want.
car loans, if you do try and get a car loan, they're pretty high interest right now because interest rates are high, right? 6.5. There's no 1% car loans too much anymore. So
Now,
it's a pretty penny.
if she would have had $10,000 of cash value in her IUL, she could have went and borrowed, let's just say 8,000 from her IUL,
Hmm.
but she would have continued to earn interest on that 10, as if that money had never been touched. She would have continued to earn interest on that full 10,000 because she doesn't
Right.
actually borrow from her existing cash value. The insurance company gives her a loan against her cash
The
value.
value. Right.
Now
Okay.
she can choose to never pay that back.
Hmm.
And we have clients who are doing that very strategy. So
Hmm.
they'll take out an IUL and they'll put $1,000, 2,000, $3,000 a month into that, and they're looking at the trajectory. I run the model for them. Like,
Mm,
okay, I think you're going to have, 1.3 million, by the time that you're 72 years old, based upon these assumptions. And they'll say, well, okay, what do I do at that point? Be like, whatever you want. You can start taking out supplemental income at that point.
mm,
What if I don't pay it back? It just gets deducted from your life insurance if you die. It's not a problem,
hmm.
right?
Right.
So you
That's
know what
amazing.
you know what you don't pay taxes on though, Athena.
The loan. And because it's tied to life insurance, there's no taxes anyway, right? Life insurance is tax
There's
free,
no taxes on the death benefit, but
right?
how do you get the money out of the insurance policy while you're still alive and not pay taxes on it? Because it's a loan from
Hmm.
the insurance company. It's tax-free retirement. If someone
Right.
wants to properly fund an IUL, an index universal
Hmm.
life policy, then they're in a position where they can also get their hands on tax-free retirement at the right
Hmm.
time. It's something everybody should look at.
Hmm.
A little bit of a different product than the one that we use to eliminate debt with. This
Hmm.
one's more towards tax-free retirement purposes. Uh,
Hmm.
so yeah, we got some
Right.
clever things.
That's awesome. I love that. Yeah, I love that. Okay, well, we're coming up on the almost the end of our time. I'll just see if there's any questions because I have not been watching. No, I don't see any questions. Okay, we're okay. So if you have any questions, go ahead and put them in the chat box. So I love that idea because you can also like if you can start young enough and build it, you really have also money to invest, to buy property, to like so many things, right? Um, yeah, so I love that idea that you could build up that account and use it for that.
What a great way to flip properties. When I was flipping properties, I mean, I did it from, either personal funds or hard money lending even.
Yep.
And, had I known about, these sorts of things, 20 years ago, by the time that I would have been ready to go and do all my flips and things like that, I could
Mm-hmm.
have had hundreds of thousands of dollars that
Yeah.
I could walk in, buy a house at auction. I could walk
Mm.
in and negotiate an owner
Yeah, you
contract and
could
buy
be
it
a
that
cash
way.
buyer and beat everybody out, right? So
Cash buyer,
so
beat
many
everybody
things.
out. No bank loan, no liens. It's mine.
Mm-hmm. No qualifying.
No qualifying, no credit
And hard
problems.
money is like 10 to 12% and some points and whatever. So
Yeah.
way cheaper
Don't
to
have
do
to
this,
qualify credit wise.
right? The hard money guys don't really qualify,
No, I know, but if you're gonna go institutional lending, you're gonna have to qualify
Yeah.
credit wise. So it's either
Yeah.
you're gonna pay for it through the nose for hard money, or you're gonna qualify for it. Either way, if you got the
Mm-hmm.
money in a properly structured life insurance policy, there's nothing wrong with that. By the way,
Mm.
this can also be done for people that just have a lump sum chunk of money. If someone's sitting around, they go, "I got 500 grand." Well, we can write a single
So
pay
you
life
can put
insurance
it
policy.
all in at once?
It's just a single pay life insurance policy. Yes, we can get that structured that way.
Okay.
So the money's earning interest right there. It'll continue to earn interest. Even if you borrow against, take a chunk out, put it back in, take a chunk out, put it back in. It's going to
Mm.
continue to earn interest on the full amount of the
Mm.
ledger, or the
Oh, that's
lump sum.
interesting.
Hmm.
So that the account's growing on its total value, not on the
Correct.
value minus the debt you took.
Correct.
Oh,
Yeah.
wow.
So it's a
That's
nice way to
really,
leverage that because, it's still there. If you die, it's still going to pay out. But it's growing. Cash value on that amount that's there allows you to get your hands on it any time rather than sitting in a bank account somewhere not doing anything.
mm-hmm. Yeah. And so people might be wondering how the math works, right? So let's just say your policy has $1 million value, but you borrowed 500,000.
Hmm.
Um, I guess you don't have to pay payments, but that $1 million has to throw off enough cash flow to pay that payment, right?
No, you don't have to make any payments at all on it if you don't want to.
So if it's negative, like let's just say my payment should be 5,000 a month, but and the account's only making say 4,500, they're not going to come after me for that $500. Are they just adding it to the balance, like
Yeah,
amortization kind of?
yeah, like, if yeah, it gets deducted. Like if you let it run all the way out, it gets deducted from the death benefit, should you
So
pass
your
away.
balance is growing, and then when that event happens that you die and they pay out the money, that's when they deduct it.
Yeah.
You owe them the interest, accrued interest, basically over time.
Yeah, that's how it works. It's kind of an interesting
It
feature that's
is.
in there and done
It's kind of
right.
like reverse mortgages. They don't get that interest till the person passes away, right? So
Right.
similar concept.
Yeah.
Huh.
So there's some tricky things that are in there that people can do, and
That's
you know,
awesome.
but the simple things for maybe a lot of your listeners or viewers, just be to make sure that you don't get too clever and too tricky, but that you got coverage in place that'll just make sure that you don't lose your shorts or your family doesn't lose all the equity if the worst happens.
Mm-hmm.
And there's proper ways to do all of it and improper ways to do all of it.
Mm-hmm.
Got to be careful, how you're getting
Mm.
these things structured. Um, Great products, by the way. Some of these products, the IULs, are great for younger folks. Get them started early. I mean, it's crazy. It's like just looking at the one I did for my daughter who's 20. It's like, my gosh, by the time she's my age, I mean, she's going to have a ridiculous insurance policy, and she just
As
plugs
long as
into
she
it.
sticks to it.
Well, her dad's the insurance agency owner, so she'll stick to it.
Right. Yeah, no, I had a bad thing happen going back to that account that I borrowed against for the wedding. The insurance company got bought out, and I never found out they got bought out somehow. And they lost track of me, even though I'm in the same house that I've always been, or not always, but for a long time. And apparently, because I didn't respond on time, they collapsed the policy because it was it was leveraged up, right? So I guess they do require you to pay it down or do something when some of these policies reach too high of a loan to value. So it's a bummer because I got that policy when I was much, much younger, right? So
Oh
you
yeah.
want to stay on top of these things. And I just, because you don't owe a payment, I never even thought of it. I didn't get mailed, didn't think of it. So it's like, I call it, when you do something sloppy, it bites you, right? So you do want to be very, very careful to pay attention because
Yeah, that's for
it's like a
sure.
gold mine that you have there,
Yeah, for sure. You got to be
you
careful
know?
with it. Like anything
Yep.
else, it takes, you have to monitor it and do your due diligence and make sure that
Yep.
you're doing the right things. Like, it's like anything else, if you don't maintain your house is going to rot out from underneath you. There's things you got to do.
Yep. Yep. For
But,
sure.
properly, it should be an integral part of anybody's, overall estate planning,
Hmm.
right?
Or even just wealth planning, wealth protection, right?
Yeah,
All of that.
all of it,
Yeah.
100%.
Right. Wow. Amazing. Well, this has been such a great conversation that started with mortgage protection that I was going to tell you is no good for people. Let's see. Okay, I don't see any questions. Well, I guess that'll do it. So thank you for sharing your time. If someone wanted to reach out to you, so did you say you're in Washington State?
I am. If anybody would like to, know more about what we do, they can go to boatmanagency.com. That's my website. They can mostly reach me through there. Probably the best way. That's going to have all my
Okay.
contact information. So, boatmanagency.com. Um, I'm happy to answer any questions or, if there's interest in any of these products, we could certainly provide, more info, upon request.
Okay, awesome. Well, thanks for sharing your time, Sean. Sorry, it was a little nebulous as to what you were coming here to do, but
No worries. I knew we were going to talk about something related to insurance, so I figured we'd get there
right,
eventually.
right. And hopefully Aaron is having a nice time in Brazil, I think he said.
He's
So,
in Brazil. Yeah, I'm
which
going to
is
give him a hard
awesome.
time about this. Like, I thought you were going to be on the call with me, brother.
I know, right? You're going to have to, especially because we were going to do it yesterday. And I said, you're just landing. It might be tricky. Why don't we do it on the 5th instead of the 4th? But I guess that didn't help because it is Brazil after all, right?
Right. I think his wife
So,
is from Brazil, so I think they go every other year or something like
oh,
that.
okay.
Well,
Okay,
thanks for having
awesome.
me.
Thank you so much. And I'll be sure to put your information at the end of this video and send you the video. And thank you again for sharing such amazing information with us.
Well, you're very welcome. You have a lovely evening.
You too. Take care. Bye.
Bye-bye.